Hello, you're watching Deal Flow, the show that tracks merger and acquisition activity in Africa and beyond. I'm Erica van der Merwe. Thanks for joining us. The South African listed property sectors had a bumper year, in fact, a bumper decade. A report by SA Revealed shows that the total value of transactions in the listed property space last year amounted to nearly 22 billion rand, up from over 13 billion rand the previous year. Is this a sector rightfully catching up on years of inactivity and unexplored opportunity, or is it headed for trouble? On this episode of Deal Flow, we talk to some of the major playmakers in the sector. Before that, we speak to Tamisha, who's got our deals of the week.
Thanks, Erica. Our Standard Chartered's private equity arm has made its first investment in the growing African power industry by acquiring a quarter of Zambia's Copperbelt Energy Corporation for about $57 million. And DBS Bank says it is buying Societe Generale, that is Asian private banking business, for $220 million. Now, it's capitalizing on the region's growing number of millionaires as Western banks continue to retreat from the business of serving Asia's wealthy. And going on to the pharmaceutical space, GlaxoSmithKline announced last week that it had paid $1.05 billion to increase its stake in its Indian pharmaceuticals unit to 75% as it banks on rising demand for medicines in emerging markets. Well, those were your deals of the week. Back to you, Erica.
The listed property sector in South Africa has been off to a flying start this year, with around 1 billion rand already raised since early January. In studio with me, Marc Wainer, CEO of Redefine, and Keillen Ndlovu, head of listed property funds at Stanlib. Welcome. Good to have both of you here. Certainly the sector in which to be working, Keillen. So you've had the privilege of the last several years to be analysing the sector.
Sure.
How would you describe the state of the sector at this stage?
Yeah, it's been quite interesting and lots of dramatic events. We're seeing consolidation happening and also volatility on the other side since the end of May last year. And the results that came out in Feb and March have been very good, actually above analyst expectations. So fundamentally, things are still good, just price volatility at this stage.
Yeah. So Marc, you've been on the other side, really sort of years of this pedigree of doing deals in the property sector. How would you describe the status quo?
Yes, look, I think we've had, I think like the Bible said, 7 lean years and 7 fat years. We've had our 5 fat years with a very low interest rate environment, which made it very easy for deal flow, and it made it very easy for new listings and capital raisings. Guys like Keillen had very big checkbooks and were looking for opportunities, so they backed sort of a whole lot of new listings. But what's changed now is that we've got higher interest rates, not just the 50 bips increase, it's the 3-year and 5-year money that are up 170, 180 because it tracks bonds. So you're seeing the smaller players caught between a rock and a hard place. They have very little liquidity in their shares, so they can't really raise money. There's not that much appetite for their stocks, and they can't really buy and compete with the bigger players. So they're having to merge to get more liquidity and become more attractive to the Keillens of the world.
So Marc, you're saying that that's one of the drivers of the corporate activity, the consolidation that we're seeing in this.
That's the big driver. There's also, of course, capital raising. I know you said 1 billion, but I think 2 days ago, MAS, which is an offshore, it's listed in South Africa, but does offshore, raised, I think, 2.7 billion, yeah. 2.7 billion in a morning or a day. So there is still appetite for the right kinds of investment by the fund managers, but I don't think there's much appetite for smaller, newer listings.
Sure.
Sure. So that boom time is over now from the smaller listings then?
Sure, because the pricing has changed, yields have moved up. So to come up with something compelling, you have to offer yields north of 10.5%, because you can get existing stocks, big, liquid, at 9.5 to 10% yield. So if you're new, you have to offer something different, attractive, and sizable.
Keillen, where does the significance fit in of the new REIT structures, REIT? So does that also make the sector more attractive, in particular for offshore investors who understand that structure now?
Sure. Yeah, well, it's that you're aligning ourselves to the rest of the world, speaking the same language. So any offshore investor understands that structure much better compared to the previous structure. We had property unit trust and property loan stocks. took quite some time to explain and break it down, but most of all, it actually clears the tax risk. So now, actually, with let's say Premium and Octodec, it's easier for them to merge because there's no capital gains tax risk, whereas before they were delaying that merger, which was long overdue. Sycom and ArchiCap, to be easier as well for them to actually merge, given the introduction of the REIT legislation.
If one were to look at the sector from a different perspective, Mark, where are the exciting trends, and whether it's regionally or by type of sector, whether it's retail, which is doing surprisingly well, for instance?
Well, I don't think within the South African market there's anything that's really exciting. I think we now have to look for other opportunities. So we're starting to see funds with residential exposure. There was recently a deal with SA Corp, took on a big portfolio of residential in Berea, Hillbrow, Johannesburg CBD. That's new. Premium, Octodec have been doing that for some time. So I think we have to start looking within the South African market for other areas. Retail will do okay, but it's the consumers coming under pressure. Offices remain weak, and the industrial market has got some signs of probably the best at the moment to invest in if you can find the opportunities, but they're scarce, and then everybody chases them. So offshore, a lot of people going to Africa, but we like, developed markets, Australia, the UK, Germany, offer better returns than we can get in South Africa at the moment.
Interesting. So you and your own portfolio then are looking elsewhere? Is that what you're saying?
Yes, we are. We do have an exposure, and we would like to increase that exposure. And as I say, I think the investment houses like it as well, given that Mass raised 2.7 billion.
So Keillen, could you elaborate on that, on your regional interest, and I mean sort of big regional outside of South Africa, and also on the rest of the African continent? Are South African listed stocks looking north of our borders?
Sure, there's been a lot actually. Over the last 4 years, we've seen most companies venture into the offshore markets. Growthpoint in Australia, Redefine with Redefine International, we've got UK, Germany and Australia as well. And then the Resilient Group through NEPI, they're playing in the Romanian space. So that's the offshore markets. And in the African space, Hyprop and Attack and Resilient as well in Nigeria, Ghana, and they're talking of going to Kenya as well, and also Zambia. So there's lots of activity.
So taking Hyprop, for instance, so excuse my ignorance, but as a portion of their total portfolio, how big is the African, excluding South African portion of their portfolio?
It's still quite small, less than 1%.
Under 5%.
Yeah. So what they're looking to do is to grow that portfolio in the next 3 to 5 years. They mentioned something like 5 billion. So it's still a long way to go in that space.
Right.
But that's going to take time. The African story is not an overnight one. I would say probably at least 5 years to see most of the benefits in that space.
So explain, Mark, why that won't be an overnight story. Is there a lack of property, a lack of developers?
Look, people are having to develop, and you can't get critical mass. So you can't go into Ghana or Kenya and say, I'll buy these 3 or 4 shopping centers. You have to find the land, develop, find the tenants, and they're finding, and I know from my association with Hyprop, that it's not as easy as it is here. Somebody was telling me rebar, which is the metal you use. If we want it here, we order it bent to this size. There it comes in pieces. You have to have a bending machine on site and do it. And this is a learning curve for all the people. So it's totally different. It takes a lot of courage, I think, to go there and do this, find the sites. There are lots of question marks about actual ownership of the land. So, and the infrastructure to get to the sites. So it'll take time, as Keillen says. I think that 4 or 5 years down the line, they'll be doing very well. But at my age, I'll let somebody else do the pioneering.
Come on, Mark. It's got to be done, right, Keillen?
Somebody else can pioneer.
Yeah, I guess if you look at, for example, say in Nigeria, I guess shopping patterns are different. They only have 2, there's a 3rd shopping center coming up, like kind of formal, big, decent regional shopping centers. Compared to us, we've got over like 70 malls, what they call A-grade malls in Johannesburg. And they've got the population there. So about changing the shopping dynamics, they're moving away from informal retail to formal retail. So there are opportunities probably in the long term.
But even for the retailers, somebody was telling me, I think it was Kenya or maybe Ghana, you can't get milk. Now that to us sounds, why can't you get milk? Get a plant a cow or grow a cow, whatever you do, and milk it. But apparently tsetse fly is a big problem. So all the milk products are powdered.
Right.
So these are all learning things. Suddenly you go, I want milk, no milk, milk powder.
Switching tack then, in conclusion, I was going to ask you about funding deals. How is that shifting with rates moving higher, Mark, if you look at the spread between debt and equity?
Look, I think there's still appetite for equity from some counters. There's not a big difference at the moment. Keillen alluded to the yields between debt and equity. So it's a question of where you are in terms of your overall gearing. The market likes sort of mid-30s or below 40. So if you're there, I would say go for debt, because equity you service forever. But it's much more expensive, so it's much harder to do deals. You know, 5-year money for us is now 9.6, 9.7. For the smaller funds, over 11. So how do you buy when the sellers still have 7.5%, 8% in their heads?
Yes.
So I think there'll be a slowdown on acquisitions, more money spent on improving existing properties, which I think is a good thing. And development is probably still a good opportunity. I mean, it's quite funny, because 3 or 4, maybe 5 years ago, for you guys, development was like a no-no, it was a bad word. Now development's exciting for you. So things change.
So final word from you, Keillen, so elaborate on that. That's very interesting. So you're looking at developments and you've got the expertise for that.
No, actually the bigger companies, Redefine, Redefine, they're doing developments. For example, across the Sandton area, for the Discovery, Redefine's got stuff on Creston Drive. So there's lots of office developments with corporates taking up or committing to that space, even in the industrial space as well, where there's opportunities.
But there's a fund now like Attack, which is largely a development fund, which 3 or 4 years ago would never have got off the ground.
Right.
And now it's the darling. So they say we don't actually pay much in the way of a distribution. This is a fund to develop properties.
Right, so it's sort of longer term horizon on that, yeah. And just to end off with, Keillen, your perspective, I was surprised to hear how low the gearing is in listed property. I expected it to be higher.
Yeah, well, around 30% or so on average. And most companies have fixed their debt about 80% fixed for 3 to 4 years. So they've been fairly conservative. Anything above 40% in our space, we tend to say it's actually very high. So companies are very defensively positioned, even in a rising rate cycle. There's only a few with much floating debt, but the likes of Redefine, around about 65, 70%. 75% geared. That's good, sorry.
No, 38% geared, but 75% fixed.
That's right.
Fixed, yeah. Well, thank you. Really good talking to you, getting your perspectives for our audience. Thanks to my guest, Marc Wainer. He's CEO of Redefine, and Keillen Ndlovu, Head of Listed Property Funds at Stanlib. We'll see you again same time next week. Goodbye.